Good morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Good morning. Welcome back to Insurance Matchmaking. We're in full swing in our dual enrollment season. The healthcare ACA marketplace, also known as Obamacare, launched on November 1st. We're still doing Medicare, also the Medicare AEP, annual election period, even though some people like to call it open enrollment. That's not the official title, even though CMS now is even starting to call it open enrollment. It gets very confusing because there's like 4 different things Medicare calls, or CMS calls open enrollment when it has to do with Medicare. So it can be very confusing, the terms, and I guess sometimes we can look at that as job security. Unfortunately, also job security, we're running into a lot of plans that are going non-commissionable, especially the Part D drug plans. And in fact, actually this weekend it'll be Humana says that they are going to take the Part D drug plans off of the the agent enrollment portals, that you will either have to go to Medicare.gov or to Humana and sign in as a member or potential member and sign yourself up on a Part D drug plan. If you want a Humana plan after the 7th, they're not allowing us to do that. I'm not grasping the concept. I know that part of it is the insurance companies don't want a lot of people on these plans. I noticed a company that I no longer deal with because they cut out our commissions and even our renewal commissions on our Part D drug plans a year ago, and now they're not going to be paying for their Medicare Advantage plans. I didn't read real closely whether that's affecting the renewals or it's just new plans, but I'm not writing that company anyway, so that one doesn't bother. Well, it bothers me on a collective level, but not on a personal level because it's not affecting me directly. Just kind of hitting on that, but I really wanted to talk today about some of the things that have been coming up with the Affordable Care Act, or so-called Affordable Care Act. As we know, the expanded tax credits were not extended as of this recording. Now things could change, an hour from now. But as I'm recording this, the government is still shut down. They have not come to any kind of agreement on the ACA marketplace subsidies. And as I had predicted, where I'm seeing the biggest issue is with those at the upper end of the income level. I've spoke with 3 couples this week that are either right at the edge of not qualifying for the subsidy, falling off that a few of us call the subsidy cliff, that cap of 400% of the poverty level. We were speaking with a couple yesterday going through theirs. So they currently, at their income estimate, they are qualifying for about, I think it's like $2,100 of tax credit. But if they earn just a few, and literally just a few $1,000s more for the year, they no longer qualify for the subsidies. I think it was like $2,200, and that's the problem. The plans they're that expensive. The bronze plan is like $1,800, or actually it wasn't $1,800 because there was a difference. It was with the subsidy that this couple qualified for, they could get a bronze plan for $40. The gold plan was going to cost them $1,200. And actually did a little math on this, and working, like I said, working with a couple different couples that aren't eligible for the subsidy anymore because they're above that 400% cap, where this past year they qualified, still had a halfway decent subsidy. It made their plans, a silver or a gold plan, actually, somewhat affordable. Well, one couple I'm talking to, the wife has some medical conditions that an Affordable Care Act, the marketplace is her only option for health care. Nothing else is going to cover. You've heard me talk about Medi-Share. Medi-Share is great, but they won't cover pre-existing conditions in the first 36 months. They won't turn you down for having a pre-existing condition, but they're not going to. I say covered. I'm not supposed to say cover when it comes to Medi-Share. They won't share the cost. And again, it's kind of like they've done with the marketplace, why we have the enrollment periods, and you can't just sign up at any time because they don't turn you down for pre-existing conditions. But the marketplace plans have to if you have a valid enrollment period, they have to cover your pre-existing conditions. So that's why they are more expensive than anything else out there. We have short-term plans. As I mentioned, Medi-Share. We have what's called fixed benefit plans. Those will all cover you if you don't have pre-existing conditions. You have health questions to answer on the application. You can list your prescriptions, and they go, oh, yep, at least we're not worried about that you're taking this prescription. Oh, you're taking this prescription, we're not going to approve your plan. So those are some conditions that will affect people when they're looking at a marketplace plan or not, or a marketplace plan alternative. Medi-Share, as I said, the members share your health costs, but they don't call it a premium. What you pay monthly, that is your monthly share, because that money goes then into the pool that they draw out of to pay people's medical costs. And then you have your annual household portion. Basically, it works like a deductible. You have to pay, in the way Medi-Share works, they have 4 levels, and it's $3,000, $6,000, $9,000, or $12,000 that you pay first. Once you've paid your annual household portion, there's not an individual. If you have a family, it's the amount for your family. Whichever of those 4 levels, it's the total for the whole family. If you've spent those, and what you do is you submit your bills to Medi-Share, and then they say, yep, okay, we can pay this now. You've met your annual household portion, and now the members will share your costs. There's no limit on that. So if someone who develops cancer and is on a Medi-Share plan, the members are going to share those costs. In fact, I actually have a client that one of the reasons he was interested in Medi-Share was because found out that there's a clinic in Mexico, very reputable clinic. A lot of people go there because it runs them about $100,000 to $150,000 for their cancer treatment. That they get very good results. Medi-Share will share those expenses. So he was kind of interested in that because of his family history. So those are some of the things. But I'm going to move back. I was kind of talking about the surgery coming up. This kind of goes back, and I think I've shared this before on the show, but if you're a new listener, of course, probably you didn't hear it, but go on YouTube, check out those past shows. If you go to insurancematchmaking.com, there's a link to my YouTube channel, and you can listen to your heart's content, all those. And I do ask, please like and subscribe those videos. That helps me get the word out that people can find me and find, I'm able to help them. I did have a couple meet with me earlier or last week that reached out to me because they've heard me on the show here, and also I've got somebody calling in, coming in to see. I think we got an appointment next week because of the magazine that I advertise in. So it costs me money to get some of these advertising venues out, and that's why you can really help my dollar go further if you like and share my YouTube channel. But anyway, I was talking about my friend who had developed epilepsy, got laid off from his job because he was a sales rep and needed to be able to drive to clients. And once you start having seizures, they say you can't drive. So he lost his job. Fortunately, he had disability insurance, so he had a little bit of a cushion there, but he was no longer able to perform the duties of his job. And Vanderbilt had developed a process that basically they drilled into his head and did something, and cut some blood vessels or something. I'm not sure exactly. I'm not a doctor, trust me, but I knew it was going to be very, very expensive. And so with his case, we looked at a bronze plan and then we looked at the silver plan. The difference in premium between the two plans was about $200, $250. But the difference in the max out-of-pocket, the bronze plan was actually lower. It was designed to be an HSA plan, and so there were caps on how high the max out-of-pocket could be on an HSA, and so that plan had a lower max out-of-pocket. It had a higher deductible, but it had a higher max out-of-pocket. And the thing is, once you meet your deductible, that max out-of-pocket is what becomes important now. If you're just going to the doctor off and on during the year, yes, a low deductible can make a difference of what you're spending. But one of the things I share with my clients and potential anybody is when you're buying a plan with a with a lower deductible, it's going to have a much higher premium. And theoretically, what you're doing is buying down your deductible. There's generally not a lot of difference between a bronze plan and a silver plan, other than what we call the cost sharing, the deductible, the max out-of-pocket, and the copays. So a bronze plan is usually going to have, higher copays. It's going to have usually a higher deductible, and then a higher max out of pocket. Now, those that qualify for what's called the cost sharing reduction, and that is anyone who is at 250% of the poverty level or below, down to 100%, because you have to qualify to get the subsidy. You have to be at least 100% of the poverty level. If you're below that, the federal government says you should be on Medicaid. That's between you and TennCare, whether you're going to get it or not, but that's how the federal government reads it. And then you have your max out of pocket. If you look at a bronze, silver, or gold plan, there's not a huge difference between the max out of pocket. One of the examples I was using, I mentioned the couple that with their subsidy, they're looking at $40 or $1,200 for the gold plan. The difference in the max out of pocket for those plans is the bronze plan is $10,000 and the gold plan is $8,200. There's an $1,800 difference between those two plans. And basically just, rough math, I'm not doing exact dollars, but if you meet the max out of pocket on the gold plan, you will have spent, because of the premium and your cost sharing, you would have spent $6,000 more in that year for your health care than on the bronze. So yes, you're going to have a higher copay, but like I said, the difference between these plans, $40 or $1,200. A specialist copay with the bronze plan is $100, and it's $60 on the gold plan. So it's $40 more to go to see a specialist on the bronze plan versus, and same thing with the regular doctor. The difference in the copay is $40. $1,200 minus $40 is a really big copay. So that's why I'm saying it doesn't really make a lot of sense to go with a gold plan. It may, like if you have a family and you're insuring, you and a spouse and 3 kids, yeah, a gold plan might make sense because the max out of pocket is double, and for a family is double an individual's max out of pocket. So those are some of the things that, and these numbers I was giving you, the $10,000, the $8,200, those are individual deductibles. So for a couple, the max the max out of pocket would be $16,400 on the gold and $20,000 on the bronze. So yeah, it's a little bit difference in the max out, but the amount you're paying, almost $1,200, $1,150 more on the gold plan in premiums. That's I think it's like $4,800. Yeah, 12 times 12. 12 times 12 is 144. So $14,400 in premium alone on that gold plan. That's why I'm saying, is it really worth it? And like I said, if you're going to have a major surgery, you're probably hitting the max out of pocket anyway. And the thing is, and even if you can't afford it, with that, you can make payments on your medical bill and just keep paying on that until you get it paid off. You can't make payments on your monthly premium. You have to make that monthly premium every month, or they will cancel your policy. They give you like a 30-day grace period, but if you get more than 1 month behind on your premium, your plan ends. Now, if you have any other health care issues the rest of the year, you're going to be paying for them. And losing your coverage due to a non-payment of premiums is not a life event that qualifies you for a special enrollment period. So, and we can go into more of that. That's one of those things that, reach out to me. We're actually up on the break here, and I'll be right back after some commercials.
Hi, this is James Green, your local Twin Lakes security sales consultant. During the busy holiday season, it's easy to get caught up in shopping, traveling, but don't forget about what matters most, keeping your home safe. With Twin Lakes Security, you can enjoy peace of mind knowing your system is always working in the background. Control your lights, arm your system, and even greet guests right from your phone. Call 931-528-2005 or visit us at twinlakes.net to learn more.
Twin Lakes Security, TN-CERT C-0026.
Join Upper Cumberland Habitat for Humanity as they celebrate 30 years of homes, hope, and habitat. It's the Remix and Mingle November 10th at the Upper Cumberland Habitat Restore, 560 South Jefferson in Cookeville from 5 to 7. Bring the kids out for balloon art, face painting, snacks, entertainment, and more. Tickets are just $10, and that goes right back to the Upper Cumberland community to continue helping families build affordable housing. The Remix and Mingle celebrating 30 years of Upper Cumberland Habitat, November 10th at the Habitat Restore, 5 to 7 p.m.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, and we're back, and please support the advertisers of this station. I was talking a little bit about the total premiums on the person's account, and also I brought up HSAs, health savings accounts. The beauty of those plans is you can contribute to those and it's considered pre-tax money, so it actually lowers your annual income. So that can help make some plans affordable. And if you are collecting a tax credit, then you could also benefit that way to have it be, it'll lower your income, so you'll actually qualify for more tax credit. But you have to be careful on that. If you're close to Medicare age, you know, if you're eligible for Medicare, you can't contribute to an HSA anymore. If you have money in the account, you're still free to use it for your medical costs. So it comes in really handy for a lot of folks is they put that money in, they kind of create a savings account, and then they have to go to the doctor and they say, well, you don't have a copay, and your insurance says you have to pay $200. You can take out that debit card and pay that $200, and it's an authorized charge. So, for you get the bill, you can pay those bills from that HSA account. So it helps build, and a lot of times with employers will match that HSA contribution. So you're taking money out that before it's taxed off your paycheck, and then if employer is matching, you can have a decent account there, and then you can, when it comes time to use that for healthcare, you take the money out, and it's not taxed when you take it out because you're taking it out for health reasons. If you take it out for, if you decide to close out the account and withdraw the money, then every penny that's in there is taxable income. So, and at least that's the way I understand it. I'm not a tax preparer, but it has to be used for medical costs. And I believe there's some ways you can use it to pay for some of your medical premiums too, so it can help with that. But so I think is what's happened to some people, like once they're on Medicare, and so they don't have a lot of out-of-pocket costs now because they're on Medicare, that they use that money to pay their Part B premium. And I think I've heard you can do that. Don't hold me to that one. I may be misspeaking, so don't take that one to the bank. But I think it does. And you can, speaking of the bank, your bank should be able to, because you can most banks will let you open up a HSA with them, and they will kind of go over those rules for that account. They should know how that works. So that's something with the HSAs. I think that's going to be a big option for a lot of folks. And as I mentioned in the first segment, looking at and quoting people's with their income and such, I had one individual that had asked me about quoting theirs, and they were paying, I think, $10, $15 a month for their plan, and requoted at the income that was on their account for last year. And it wasn't the exact same plan. Again, it was one of those, the plan they had is going away, but the plan that was very similar to it was going to be $30. So if you're on the lower end, where you qualify for really good cost sharing reduction, and of course that was on a silver plan, could have got a bronze for zero. And those are the times I don't recommend somebody get a bronze plan, is if they're getting the cost sharing reduction on the silver, then yes, they're paying a little bit more for it, but they're having a reduced deductible, reduced copays, reduced out-of-pocket costs. They're going to come out ahead if they're paying a little bit on that silver plan and utilizing that cost-sharing reduction. Now, what happened this past year, and I think is still kind of applicable to some folks that might qualify for the cost-sharing reduction, to really look at it, because they're closer to that 250%. The cost-sharing, the reduction is not that much. So sometimes, even with the cost-sharing reduction, the gold plan might be still a little bit better value than the silver, because with the premium reduction, you may have a lower deductible on the gold plan. And sometimes it'll happen. The gold plan max out of pocket will be just a little bit higher, but it can be a significant difference between the deductible and then those copays as you go. So the gold plan can make a little more sense there. And the reason I bring that up, some people, if it's not that much money for the silver or gold plan versus the bronze, sometimes those can be a better solution because of the lower copays, especially when it comes to prescriptions. If you have a lot of prescriptions, and especially if you have brand name prescriptions, the bronze plans, a lot of them won't cover a brand name until you've met the deductible, and some plans have a separate drug deductible that's going to apply to those brand names and doesn't apply to the generic tier 1 and tier 2 drugs, and so that those can still be a low copay. So again, those are the things that we try to help you figure out, and I don't expect you to figure that out on your own, but I did want to get this information out here, at least to my listeners, so you'll have kind of an idea if you meet with us and why I'm telling you, yes, this high deductible bronze is going to be the right choice for you because it's such a premium difference between it and the silver and the gold. And then somebody else, I'm going to say, you really need to get the silver. Yes, I know you can get the bronze for $0, but if you can have a $700 deductible with a $1,500 max out of pocket on a silver for, say, $50 to $80 a month, that's your better value. Free is not always great. Now, if you never go to the doctor, and that's the way you expect it to go, hey, I'm never going to go to the doctor, I want that zero premium plan, yeah, that can work. But just remember, something happens, you are going to have those big out-of-pocket costs. The other thing is, I try to, I don't know why it seems so hard that I feel like I'm trying to convince people, is when you're looking at, and I didn't keep track of the number on this silver plan, but it was like $1,200 for the gold, the one I was talking about, the $40 for the bronze. I think it was the silver was going to be like $900, somewhere in there. It was less, but even it's I think maybe 8 something. But just to use round numbers for an example, if you're paying $900 for a plan that has a lower deductible, that's still a fairly high deductible. It could be $3,000 to $5,000. You're not going to meet that deductible unless something catastrophic happens and you land in the hospital. And you're looking at maybe $20 difference between the doctor copays. Prescription copays can be a little higher, but if you're paying, over $800 a month to have a lower copay, you got to remember when you go to the doctor, add that $800. And you can add the 800, if it's in March, that's 3 months. So, 3 times 8 is $2,400. So add that $2,400 to your copay. $20 savings on a copay didn't save you anything. You paid a lot for that lower copay. That's why I really recommend a lot of times the bronze plan is going to be better for you. Again, a lot of those bronze plans, I believe, I'm double checking on it because the numbers have changed of what's allowable, that they could be eligible for an HSA. So I'm double checking on that. The plans usually would put it in, somewhere in the description of the plan, put the letters HSA in there, so we knew that was an HSA eligible plan. I use a tool called Health Sherpa to quote marketplace plans, and when I did a quick search this morning, it brought up a lot of plans that I didn't realize were HSA eligible. So I want to double check on that. I didn't have time to get that answer for you this morning. I wish I'd have thought of it last night, and I could have done a little bit more research. But I will put out more on that as I learn what's going there. We're early into this enrollment season. Like I said, this is the first time after 2 years of not having those enhanced subsidies. I did warn a lot of people that were on the upper end of the spectrum saying, yeah, you're getting the subsidy now. It makes sense to go ahead and go this way because, hey, you're going to be paying $300 a month for your insurance on this $2,400 plan. Made a lot of sense. This year, they're not having that option. So it's really going to be a burden for a lot of folks on the upper the higher incomes. But we do have the 3x1 short-term plans. I've talked about those several times. Short-term plans are underwritten. You do have to medically qualify to get those plans. Many pre-existing conditions will bar you from getting those plans. Having high blood pressure, high cholesterol, taking a thyroid medication, those kind of things are not going to knock you out of a short-term plan. But if you have, chronic disease like diabetes, COPD, had a heart attack in the last couple of years, had cancer in the last couple of years, those kind of things, you're not going to be able to get those plans. You're going to have to basically get a marketplace plan. I already mentioned the Medi-Share won't turn you down, but you're not able to share your expenses for 36 months on pre-existing conditions. So that's not the best option for everyone. In the short term, obviously, is not the best option for everyone either. But those 3 one-year short-term plans, the beauty is you pass the underwriting now, you don't have to worry about that underwriting for the next 3 years. At the end of the third year, yes, you may have to reapply and go through the health screening again, and you might not qualify at that time. But you can save thousands of dollars going that route if you never go to the doctor. or go very seldom to the doctor. And then, of course, we always have what I mentioned earlier before the break is the fixed benefit plans. I like those plans. They're very affordable. They're very affordable for the younger crowd. Is they just want something that, hey, I know I'm only going to pay a copay when I go to the doctor, or this is going to pay $50 or $75 of my doctor visit. Oh, if I have a surgery, it's going to pay so much of that surgery. If I go in the hospital, it's going to pay me so much per day to cover my hospital bill. Those are great. The downside with them, they are not, I always say, they're not insurance. They are not major medical insurance. They are health-related insurance. They will cover a lot of health expenses. There is not a maximum out-of-pocket cap on them. They have a cap on how much they will spend on your care yearly and lifetime. And in most cases, that will cover everything. But you have something that's super catastrophic, that might not be the best plan for you. And I know a lot of agents, you call 800 numbers, they're going to present those plans as a no-deductible health plan. Well, there isn't a deductible. That part's true, and it does pay for a lot of your health care costs. But presenting it as major medical, no, that's not it. And that's why I like to get out information like on this show and when I talk to clients, when I present the plan to them. Now, a lot of times what I'll do is I'll combine one of those fixed benefit plans, especially a young person, it's very inexpensive, is take the highest deductible short-term plan and then get this fixed benefit plan to cover the doctor visits and those other things. So you've got something that's going to pay for your health care. So it's like buying a gold plan in a way, but you had to do two plans to do it. You got one with a really high deductible that if something major happens, you hit the max out of pocket on that, it's covering. And the other thing is, beauty on that is you're getting the bill to pay. That bill is counted on your health insurance and is credited towards your max out of pocket, your deductible and your max out of pocket, and you're sending that bill to that fixed benefit plan to reimburse and pay for your health care. So in a lot of ways, you may meet your deductible or max out of pocket and not actually spent the money, or maybe you had to spend it and get reimbursed, but that's a great way to protect yourself against those costs. The other thing is I have a plan. When I got appointed with Medi-Share, the company that I'm appointed with to market those plans, is a plan that's called Wellness Share. And Wellness Share it's a companion plan. I say it's a companion plan because, again, as I talked about, you have to hit that annual household portion. They don't share your preventive stuff. Same thing with short-term plans. And this plan has 3 levels. One is $99 a month for an individual. Will cover all of your preventive stuff for the year, and there is no health questions on the plan. It is a guaranteed issue plan, and then there's higher levels that will cover doctor visits and prescriptions and hospitalization. Now, those plans, they don't turn anybody down, but there is a 12-month waiting period for pre-existing conditions, so it wouldn't cover you going in having a surgery 6 months later. So looks like I am out of time. So until next week, remember at Matt Libby Insurance, we can cover you from head to toe. It doesn't have to cost you an arm and a leg, even though this year it seems like it is. But keep listening to us at Insurance Matchmaking here on Grace 107.7, and we'll talk to you next week.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.